Not going live yet. There it goes. I got it.
Now, do you think I should talk in the clubhouse room or just here on Zoom?
Clubhouse room.
Okay, that's what I thought. Let me just still. You understand where we're going. How's the sharing going?
Good. I'm just about there. Got it out. Okay.
Have you started the room yet?
Got 2 minutes.
Okay, I'm just checking. I got the link in front of
I'm
me. It
good.
says start event. I don't want to mess you up.
No. So on your see, but you're blurred. So well,
All right,
okay.
I'm gonna mute myself.
Okay. Get
I'll
started here.
see you in the room.
See you in a room. Good morning, everyone, and welcome. This is Joe Scarice, your co-host and co-founder of the Creative Bird Strategy House and podcast here on Clubhouse, providing education, networking, and strategy every Sunday morning, 9 a.m. Eastern Standard Time. Today, we are celebrating our 100th episode of our podcast, which I'm really excited about. I want to thank Yordell Perkins of Mr. Yordell Perkins of Perkatech, who's provided pretty much the backbone to this entire podcast this morning. And he's one of our main sponsors, of course. I want to thank Miss Linda Pelagas of Realty 411, who is a national publication publisher and provides national events throughout the country, which I've collaborated with in the past couple of years. I'd like to thank Lendmark Capital, where I am a direct private lender and senior loan analyst, uh, offering DSCR, fixed to rent, fixed to flip, uh, multifamily, mixed use, and new construction throughout the country. Would like to thank MB Capital Solutions, which provides unsecured business lines of credit for real estate professionals and business to business throughout the country, where I'm a referral partner. I'd like to thank Elite Dealmakers, where I host events on their behalf in the New Jersey and Pennsylvania market, that new affiliation, which I'm pretty excited about. I'd like to also then thank TCS Property Management Services, where I hold my real estate licenses in the state of New Jersey and Pennsylvania. So we'll get started here in just a few minutes with our subject this morning, which is the future of private lending. Love to get things going here in a few minutes here. I just want to get rolling. So I think Yordell's coming on here for a few minutes. Yordell, good morning and welcome. Yordell, are you there?
Morning, can you hear me?
Yes, I can. So
Thanks
Yordell,
for having me.
thanks for coming in. You're the Oz behind the drape. So what's your thoughts on our 100th episode? Where did this all start, and what's your feelings on it going forward?
Well, there's a couple of ways that question could be answered. I guess conceptually, if you want to dig into the bowels of our history, this started at COVID when everything shut down, but we basically wanted to keep in contact for our power team and keep putting out information. So we were basically doing Zoom podcasts, like I think 2 or 3 times a day. I think at one point you quipped that we would have talked to a pigeon on the sidewalk if we could have, but we kept in contact with our network and our contacts. We kind of fell off for a bit, but then I think about a year ago, you wanted to really reboot this, and we came up with this. At first, it was bi-weekly podcast. We were doing it Saturday and Sundays. And then when we got our footing, it was okay, let's just cut it down to once a week, and here we are.
So my thought here is, you don't come from a real estate background, but we met through obviously a networking event I once held up in the past 10 years. What have you seen with this industry being part of not just this podcast, but networking in general with real estate professionals? I mean, do you see a difference between the discussions that you're hearing me have or you're having with individuals before COVID and present and present post COVID? So any thoughts to that? And then we'll get into our discussion this morning, the future of private lending.
Definitely. I mean, to put it succinctly, there's an old saying that goes something along the lines of the only constant is change. And as far as real estate, I think when I first met you and I started getting into this, the whole thing was, well, the technical term became house hacking, which, again, as you said, when you did it, it was common sense. And that was a big play. But over the years, it seems to be merging into the thing of private equity, whereas a bunch of like massive organizations are buying a lot of homes. I mean, multifamily, but also single family homes, and just renting them out. So, and it's getting to a point where people are struggling with, for various reasons, of buying their own property and having it for a home. So it's just a lot more renting going on.
Yeah. Well, I appreciate everything you've done, Yordell. I feel like we're peas and carrots when we hit the events together. We did a great event yesterday, which I'll go into details in a few minutes. And I can't thank you enough publicly here on the podcast, but you've been such a great asset to what we're doing here and what people don't really realize with all the events that we're holding and the podcasts that we're holding every week, the events that we're putting together. You're a major piece to this whole platform. So I want to thank you here on our 100th episode.
Well, tell you as I tell everyone else, and it means all the more to you and for you. I deeply appreciate you allowing me to help. Like I don't take it for granted or lightly when people come to me for advice or allow me to assist them. Again, as the saying goes, there's always a better magician. That there are people that do what I do who I'd like to think I'm a bit better than, but I also know some people who are much better than me. So yeah, when I'm lucky to get someone who's willing to talk to me and deal with me, yeah, I don't take that lightly, especially with you, because I see the impact you have on such large areas and groups, and how when just a little thing goes wrong, it's an issue for you and your clients. I'm happy to be here, and I hope you'll let me continue to be here.
Oh, absolutely, man. We're a team here. So thank you, Yordell, for being here and coming up. Usually we don't get Yordell to talk too much here. He's usually in the background of our podcast, cutting and editing. But thank you for coming in this morning. So let's talk about the market right now first, and then we'll talk about events that we've had in the immediate past, and then what we have going on in the month of May, which we're very excited about. Announcements here. So the market today, yearly calm and strong for this past week, but the lowest mortgage rates were in the past nearly the 3 weeks this past week. So rates kind of leveled off at around construction money at the end of this week was at 9%. So for brokers and correspondents that are out there, you're probably looking at a 10% risk on interest rate because you're in the front, or you're giving a really great discounted rate at 9.5%, and you fix to flip is getting more aggressive because of inventory issues. So and the rate for DSCR, whether 12 has held steady this past week. There was a slight quarter point drop, nothing that significant, maybe an eighth in the rate, but nothing significant enough to make a big difference. it just maybe leveled off cost to the rate itself, whether for the client or for the lender. Jobless claims remain very stable range. Labor market seemed frozen in place. Little stagnant area in the early spring market here. We're not having a spring market. It's kind of like the spring market to me, and then most professionals start the day after Super Bowl. Not seeing a lot of people like flying off to the this out of the stables to buy properties. Okay, I'm seeing investors trying to identify opportunity, still having a rub in identifying opportunity, claiming inventory issues. A lot of the real estate professionals I'm talking to are going off market, doing the best that they can to see what they can do to identify off market opportunities. You're seeing more people investing money into ways of finding or identifying opportunities off market, not really depending on the MLS, but I still think the MLS has a robust opportunity there as well. Mortgage delinquency rate increased in March. Also, home sales are down about 5.6%. And then multifamily, institutional multifamily, and Yardell briefly discussed this, family is starting to see a slowdown in occupancy and higher days on the market, and way more discounts being given to attracting the newer tenant to come into their multifamily space. I'm seeing affordable housing rental units increase in the urban settings. Suburban settings is still a blend of affordable housing and market rent, but I feel like most of the major cities have completely gone hot and heavy into the affordable rental market, and including housing authorities now competing with the landlord head on by identifying opportunities for themselves to fill vouchers. I'm also seeing, you know, some markets hitting that are doing very well throughout the country. Some hot neighborhoods that you want to keep an eye out. Maybe the surrounding areas of these hot neighborhoods, like Prospect Heights and Clinton Hill, New York, Jenison, Michigan, Campton Hills and St. Charles, Illinois, Fairpoint, New York, Pope Gulch and Russian Hill, California, Great Kills, New York, Franklin, Wisconsin, Prairie Village and Mission Hills, Kansas, Lakeville, Minnesota, and Bowie, Maryland. Now, these are areas, and I will post an article to this as well. So if you're not following me on Instagram or Facebook or LinkedIn, please do so, because I post these articles continuously 3 to 4 times a day with different insights and updates, whether it's to educational events and opportunities. And then also, just to finish off, some article information for the day. Average U.S. apartment size is on the rise. So apartments are coming in bidder. They want to keep tenants longer because there's obviously the concern of home ownership opportunities. So they want to make people feel like they're at home, and they're making these apartments larger. So now the single family row home is competing with institutional apartment builders that are trying to build out places that are just way more comfortable, a little more storage, a little more of the amenities that can compete with having the single family row home, 3 bedroom, 1 bath and a half with maybe a semi-finished basement. So you're seeing some of that movement going on. So let's talk about events this past week. We just had our non-QM white label asset-based lending course yesterday. We had 25 people there, really entrenched for about 2.5 hours, deep into underwriting files, understanding the questions that need to be asked, cutting out the fluff, and getting to the bullet points of being either a very smart real estate investor or very, very smart up and coming broker correspondent working with a direct private lender. And the enthusiasm, the excitement, the questions, the engagement, no one got out of their seats for 2 hours. And I want to thank First American Title, David Injami, who provided breakfast and the host space in Haddonfield, New Jersey. I thought it was a very good flowing event, and very excited about what's coming out of Elite Deal Makers, and now my sponsorship and support of the Sub 2 community. which is another unique opportunity of providing recognition to a very creative community of real estate professionals throughout the country. We are sponsoring as many as we can kind of get in front of, because I feel like, when you get a mass amount of people, there's a mass amount of opportunity. So if 100 people come to an event, your rate of return of meeting people and of creating that team of experts, I think, is so important. So yeah, we had that influence yesterday of sub two community. We had influence of the elite deal makers groups and real estate professionals I've met throughout the years. I mean, there was people there that I hadn't seen in 7, 8, 9 years. I'm having conversations with people I haven't talked to in 10 years in the past 2 weeks. It's very exciting to see that, and people willing to come back and meet and greet and talk and discuss and strategize. So the event on Saturday was fantastic. So I'd like to just give you a little prelim what we got for the rest of the month, and then going into next month, we have a deals and dinner masterminding with Joseph Martella, who's a moderator of ours here on the podcast in the clubhouse, as well. Monday night at Haddonfield with Marcus Williams. They dive deep in discussions. David and Jimmy will be there to support Lenmark and First American Title. 6:30 to 8:30. So if you're in the New Jersey market, please feel free to come by there and meet and greet with them. I'll be in York, Pennsylvania, representing Lenmark at another function. On Thursday, we are hopefully I think John McAllister, who is not on here today, but he a big fan of John and what he's doing within the sub two communities, bringing it together, at least in the Northeast region, with a lot of the sub two community members. We're bringing in, I'm starting an event in Connecticut with elite deal makers, but I'm bringing in the sub two community through John. And I met a couple of the players that are up in the Stamford area and everything. And we're going to tying that in at my office in Westport, Connecticut on Thursday. On Saturday, I'll be in Rhode Island at the Rhode Island RIA up at the Crown Plaza in Rhode Island, somewhere outside of Provincetown, but I could send you the information if anybody's interested, discussing asset-based lending. I'm hosting a luncheon. Then we dive into the first Saturday of the month in Haddonfield, New Jersey, again at the tap room, with aligning with John and Alex Rubin, and we're going to support that event. And the elite deal makers and sub two community members are all going to network in Haddonfield at the tap room. For second Monday of the month is in Philadelphia at our office in Newbold Exchange, where John McAllister and Larry Van Pfeiffer are collaborating on that group. Second Wednesday of the month, we are in Lehigh Valley with John, and as well, we're kind of doing a mixed blend of elite deal makers as well as sub two. But we also have a CE course on asset-based lending during the day at the same location in Lehigh Valley at the Bethlehem Brew Works. Third Tuesday of the month, we're in Jersey City at the 902 Brewery, which really a lot of excitement. And then we also have two on Saturdays, the first Saturday and the second Saturday. First Saturday is in Union, New Jersey with Jason Stain. And the second Saturday is with John McAllister and Colin and Abraham, who are providing another event. We're having that actually at our office in Newbold Exchange. So we got like 5 or 6 events going on. I'm excited about coming back out to Pittsburgh. I was just out in Pittsburgh with Brittany, who holds a great real estate networking event, which is kind of sub two-ish and networking. And I know there's Adam below here listening in, and we had a great conversation. We're going to do a collaborative white label workshop, and I've provided him some of the information so at least he can get ahead of the game to kind of understand and absorb some of the details that I send to people to kind of learn how to white label and understand the non-QM space. So I'll be back out to Pittsburgh a couple times in June. So very exciting opportunity. So like if there's a meetup that we could help you with or an event, Lenmark, First American Title, MB Capital Solutions, we're here to support those events because we are into creative financing strategies. So let's get into our discussion this morning, the future of private lending. And I just want to make sure you understand what private lending to me is non-QM, non-qualified mortgage. It's the future of, I think, the entire lending industry when it comes to real estate professionals. It looks dynamic and potentially very lucrative for a lot of different people in different levels, especially as the housing market evolves and traditional lending continues to tighten. And I'm going to take a high-level look, and then we're going to get into our moderators this morning, where things are heading. The growth potential is increasing demand as traditional lenders uphold strict DTI ratios and income documentation. More self-employed individuals, gig workers, real estate investors, wholesalers, and those with non-traditional income sources will seek non-QM options. As we have an aging population of retirees, borrowers with assets but limited income may also drive growth in products like asset depletion loan. Tech savvy in non-QM, offering way more sophisticated risk modeling, faster processing, and better borrower experience. And lenders are increasingly looking at cash flow, bank statements, or even rental income histories instead of W-2s. And then there's the regulatory challenges, tighter oversight as the industry grows. Expect increased scrutiny from regulators, especially with loans performance falters. Now, we are starting to see some problems with some of the non-QM products, but I think they're catching it ahead of time, where I think the banking industry has a lot of problems with mortgage delinquency where they don't catch it ahead of time. I think, in a nutshell, non-QM lending industry is poised for continued growth. I predict, and this is a prediction in the 1 through 4 space at least, for investment properties, I think we're going to be 75% of the business over the next 5 years compared to banks and credit unions and local banks. And I think there'll be a rural piece of allowability coming into play for some of this non-QM opportunities, because a lot of the rural opportunities get a little wacky with us for now. That's for now. And I especially think the traditional system leaves behind more unique profiles. However, the future will hinge on responsible adoption and regulatory. So let's start with the asset-based lending class. Dave, good morning and welcome. Brief overview, who you are, what you do, thoughts to the future of private lending and non-QM.
Hey, good morning, everybody. Thanks, Joe. Can you hear me okay, Joe?
Yep.
I wanted to and thank Yardell. Yardell is definitely an integral piece of the puzzle to put on events as a team. Yesterday was quite obvious as I was running around worried about access to the building and food and things like that. It's really great to know that I don't have to worry about IT stuff and chords and audiovisual things and stuff like that. So Yardell, thank you very much. And so as far as what Joe just said, yeah, absolutely. I have been dealing with conventional mortgages for most of the last 20 years. And I definitely see a surge in the non-QM space. I do agree with Joe that I think that in the next few years, we'll see that grow to over 50% of the market. I'm not sure about 75%, but definitely in the investment property space, I do definitely see at least 75% of the market share for non-QM. It's just easier for most borrowers. It's a better fit. And, yesterday was a great event. You can always tell how much people enjoy an event by basically 2 things. Number one, how far they travel to get there. We had some people come from over 2 hours away. And number 2, the main indicator for me is always when the event is done, how quickly people want to leave. And there are people there that would have stayed all day if we were going to be there all day. So they were lingering, they were talking, networking. So that was a great sign. There's a lot of excitement. And for those of you that don't know me, I should have started with an intro. My name is Dave Injami. I wear a few hats in the real estate industry. First and foremost, I have joined Joe's team this year, so I help him in a variety of ways. On the lending side, number 2, I handle title insurance. I can handle a title order anywhere in the country. And number 3, property and casualty. I also hold a producer's license in that. So if you need a homeowner's quote, I'm very happy to get that for you. And I'll leave it there and throw it back to Joe.
Dave, I almost had to do an Irish goodbye. I couldn't get out of there because I had to go to another event, and because I had to present at another event at my home office in Philadelphia for another 25 real estate investors that John McAllister and Duran were hosting, having a discussion on multifamily. And the excitement at that room was just as exciting as the room I had left. So it was just an amazing morning of education and networking and strategy and devising and creating things. And I love that. I get really pumped up for that stuff. And I think private lending is the backbone to all of this. I mean, all these individuals, most of these people are self-employed. So, I mean, for the most part, 15 years ago, they were looking from the outside in. And then as COVID came, that almost was the best thing that ever happened to private lending. People had the time to read and review what non-QM lending was about. I mean, most of your title work and property casualty discussions, are they home buying or are they non-QM at this point?
Definitely more non-QM.
Where do you see home buying going comparatively to the private lending space? Are people just done with buying a home? They rather rent than buy rental properties?
Well, I would say right now there's a lot of moving parts on the primary home buying sector, and I wouldn't put it in the terms of they'd rather, but a lot of them, especially the younger crowd, the Gen Z, a lot of them that I come across would like to buy a home, but it's just out of their range. They feel like it's an impossibility with the home prices. The rate hike in the last couple of years really hit them with a curveball. So they just have settled in and put their mind.
Yeah. 100% finance for creativity and the opportunities with investment space in the past. Potentially go up to 90%, 100% of renovation. I then origination program based on the rate being provided for you as long as you have a 700 credit score above at 0% for your down payment. Buy, renovate, rent, refinance, and redo at 100% finance. That didn't 5 years ago. Now, again, there's some moving parts for them who have the experience, and you're newer, you need 20%. Okay, fine. Your business line of credit, and you put 20% down. We want to keep your closing costs low, so we bump the rate. No origination, so your closing costs are extreme. You're into the product. If you buy it correctly at closing, you are after repair value will work for DSCR on the way out. Or if you have enough room on the back end, maybe you flip it. Again, there's unique opportunities when it comes non-QM versus QM mortgage. A QM mortgage comparison, they can't recognize that line of credit, right? A true non-QM lender does a soft pull. They don't do a hard pull inquiry. They're not banks. They follow guidelines. They don't follow regulations. They don't follow DTI ratio. Credit score requirements are different. A bank traditionally or a QM lender needs 680 or better. A non-QM lender needs 660. The LTV ratios are at par to a QM lender or even better in some situations. Single family, potentially you can go up to 80% on purchase. On all refinances, you're at least at 75%. I really would be cautious of any of that bait and switching out there that's 80 or 85% of refinance. If that market shifts on you, you're upside down with them. Okay, so interest rates are better right now because right now DSCR on non-QM is 30-year fixed. Banks or not, or QM lending really can only facilitate 5 or 7 1 arm with a 30-year. And that's a reset, whether it's balloon or adjustable. So, and they need to collect every piece of paper on you from birth. Where here on non-QM space, you're collecting bank statements. Now, there is a data verify. They do a background check. So you're going to need to be honest of who you are and maybe provide letters of explanation. And that's fine as long as it jives. But have that conversation with your lending specialist before, not when everything's submitted and you find out after the fact. I think there's more market growth in the non-QM space, and the excitement is really there. When I run into banks or bankers at local banks, I was at a lending panel this past week before I flew out to Pittsburgh, and I met some of the guys and gals that I used to work with at a regional bank. I mean, they don't look happy. They're not busy enough, and I would agree with them. Why? They're really looking at bigger development opportunities where they could close, they could not close. I'm working on 25 different things at the same time. I'd rather have 25 things than one or two. That's how I look at things. Good morning, Felix. Welcome. Brief overview of who you are, what you do, and thoughts or discussion, the future of private lending.
Grand Rising, Joe.
Grand Rising.
On your 100 episode.
Well, I feel like it's my 100th year, Felix, but it's okay. I went for a long of being 55.
That's funny. You don't look it, so don't make yourself feel like it.
Thank you.
Grand Rising to everybody. Buchanan Biz Enterprise, the JLix Group, Tim wholesaling. I help investors with rehabs, credit repair, business funding. In reference to the discussion, I feel like that's exactly the route that I've looked to go over the years. Majority of once I started doing heavy investing, private lending was the way that I looked to go, mainly because of a lot of what you just said. It's the interest fees are less headaches. It's a more exclusive relationship. When you build that relationship with those private lenders, they're gonna do more projects with you as the relationship grows. They're going to give more flexibility as you're doing more deals because of the fact that they're seeing that it's coming in abundance versus the regular banks. For them, it's just strictly about these numbers, and they don't have the wider range of understanding of what real estate investing is. Why? Because they're a banking institution, and that's all they're focused on. Even with doing the business funding, that's even though we're using the bank, it's a different rate in how we're leveraging the bank's funds, getting cards or getting lines of credit with 0 APRs over this course of time. So you're not necessarily handcuffed by the bank the way that you would if you went the traditional route. Hard money lending, obviously, another route to go but it's still not the same as if you were using private lending and, people giving you funding based off of, oh, well, I've been in the business before. I understand what this project is like, and will be able to provide not only better insight, but understand give you a better deal. How it not only benefits you, but then how it benefits them and how the relationship grows. So, and I'll pass it back over to you.
You brought up two great points, Felix, and thank you as always for coming on here. I've known Alex. I've known Felix 20 years. I think we're going on right now. So,
yeah,
exactly. So, the funny thing about going to a QM lender, you close a loan with them, and then you go back for another loan the next week, and they talk to you like they never talked to you before. You're basically starting at ground zero again. Where if you're with a non-QM lender, like when I close a loan with somebody and they come back with me the next week, all I need is this, this, and this. I have everything else. So we'll get the appraisal order. We'll have this thing closed in 15 to 20 days. It's a whole different discussion. You're already at the 20 or 30 yard line with a non-QM lender where you actually had to, like, you call these people, they like, oh my God, we have to start this whole thing over again on the next loan. And it's insane if you think about it. You're like, wait a minute, you have all my documentation. Yeah, but it's a whole new loan. It's a whole new DTI. It's a whole new this. Yeah. I think the investor interest is kind of like increasingly attracting toward the non-QM because once they have a relationship with somebody, especially with me, I'm going to do everything I can to discount this, do this, make this work. Okay, listen, we have two loans going at the same time. I'll do the underwriting fee for 995 on this. I'll do this one for 375 on the second one because we're closing both at the same time. The legal fee I'll discount. I'm doing everything I can to make it as wholesale friendly to someone where I think in the regulated space, they had to look through a specific lane and there's just no room to make any changes, right? There's no
Right.
flexibility.
Yeah, that lens is very, very, direct to that. And if it doesn't fit within that scope, then you're screwed.
Yeah. Yeah. And in your market in Baltimore, pretty much an investor haven. You have to have the flexibility and the vision of after repair value and understanding your market values, and communication is everything, especially with the out-of-state landlords, the out-of-state business that's calling you for those opportunities. You got to stay so on top of that. And it's insane. And that the thing is, a bank can't keep up with the speed, the expedition of a file. Like I could put a file together and get it rolling and get it closed in 15, 20, 30, like quickly. We just want to get it done. And this is another thing. The whole appraisal thing is changing. It's evolving. So if anybody's not aware, in the non-QM space, I can pick my own appraiser. I'm not regulated. I could pick an appraiser that I feel I'm comfortable with that's going to provide good service. And that's an appraiser that might be one that you want to use in your space. Like when I go to another market, they're like, hey, you're not from here. I said, don't worry about me. Worry about your appraiser. Is your appraiser from here? Do they know your market? Do you know this appraiser? Every investor with an get them understanding what you do and what your type of work you do, because that's going to be more important than the originator, whoever you work with. Because if you have a good appraisal and a good appraiser, that's half the battle in non-QM. There's no regulations in me not allowing anyone to not use an appraiser that they prefer. They're not going to do anything illegal. They're going to make you feel comfortable in what you're doing. Amy, good morning and welcome. Brief overview who you are, what you do, and the thoughts to the future of private lending.
Association, the Industry Trade Association, and I mortgage tech in that because the only reason you get a mortgage is to buy real estate. So I'm now on a walk, so I apologize if they read me. And I'm also a prop tech startup founder. I use AI for several different real estate applications. So future private lending, I think from a technology perspective, its valuations are going to change. There is an appraiser shortage in the United States. And I think that as our building and property data gets better and better, and I'm seeing, if you think of CoreLogic and First American Title, and a lot of the other main data sources for a lot of what the industry uses around appraising, I think that just transitions over to AI. And I'll tell you that I've seen some startups that are going that direction, but not only from a valuation perspective, but even from a site selection perspective. I think lenders are going to be able to mitigate risk in a much better way than they ever have before, and data and AI tools that are coming out now. Now, will they trust it? Probably not. I don't know if they'll trust it, but if they got an ambitious lender that's tech friendly, that wants to run models in parallel to what they're doing today, I think that's how those lenders will get advantages. Because talk about speed of file, you'll be able to do evaluation on a property in like 5 seconds. You just type in the address and it'll tell you. And some of that happens now with Zillow, but a lot of people don't trust Zillow. So I think you'll get better and better, more accurate models going forward. And then also there's going to be more and more data available, not just about the property and its location, but the inside of the building, the condition of the building, whatever it might be, you're going to be able to pull that data too at some point. I think that's a missing piece right now, is we don't have what's actually the current condition of the building. And that's kind of where my company comes in. But I think, but I'm not the only one chasing that. So yeah, I mean, I think lending becomes more transparent, and if it becomes more transparent, then it becomes more efficient. So that's kind of where I think it's going. Thank you, Joe.
Half a nickel. Hey, Amy, from you. I mean, are we 3 years out from the appraisal industry completely revamped? Yeah, I think we're 3 years out. And how far ahead is non-QM compared to QM lending in this appraisal revamp? I mean, I think non-QM is like 25 years ahead, but I could be wrong. I mean, how much is it going to, can the QM banks afford to make these changes like the non-QM is already there? They're already there. They're already doing this. So like,
Understanding is that they are throwing a lot of dollars at it.
okay.
I mean, everybody is understanding that they need to implement AI. Like 80% of businesses are already doing it in some form or fashion. And AI is what changes the game, right? So they're looking at it now, whether they trust it enough to lend on it, that's a different story. And I don't know if anybody is willing to trust it that, but I think a lot of things, that's the thing, that's what going to make the difference, Joe. So when you start seeing, they call them small, you can ask it any question and it's going to give you generic knowledge. Fees work, right? So we just care about real estate stuff. So what they call them is our small language models, where you build a model, all it knows is real estate, in and out, and you train it to look at. You add people to train the model. That's where it becomes more and more. Like somebody who's, you can pull all the CCIM doing this in and out to train those models. Knowledge, the tacit knowledge. You back something useful, but real estate's always been about tacit knowledge. We don't really tend of that. So now it'll get better, because I think, I mean, if Facilimax, we're creating one, we're creating a small language model for real estate. I think others will recognize the need for that and do that too. So it's not just us, but I think 3 years out, you can definitely do valuations on real estate without using an appraiser. Will they trust her or not? I don't know. And I think the banks are trying to play catch up right now, Joe, and they do have a crap ton of money to throw at it. So it doesn't take long for you to catch up when you've got a lot of money. Just saying.
Thanks, Amy. I really appreciate it. And Amy, I want to point something out. Amy brought up transactional experience in real estate cycles. Right now, most of the people in a lot of these industries don't have that. They don't know anything about the 2008 mortgage crash. They don't know anything about the unemployment issues in the early 90s. They don't understand the issues of inflation in the 80s. Most people don't even remember the odd and even license plates to get gas. Okay, that's on this call right now. They don't even know what I'm talking about. Okay, and that's going to separate a lot of people being extremely successful in being quick-witted to what's happening in front of them, comparatively to people that have never experienced different phases of a market cycle, whether it's expansion, it's peak, it's contraction, it's a recovery. Yeah, Charmaine remembers. Oh my goodness, we're all aging ourselves, right? There's so many things you need to think about transactional experience across various cycles. Okay, so you really need to surround yourself with a team of experts that are going to facilitate insight, being able to pivot, like where I recreated these networking events, right? And then I identified these groups and communities that were so active in working together. And I'm like, gosh, we got to put this all together. This makes so much sense. And then we got to put an education piece to it. And then we got to tie it into the podcast. Now I got to spend money on social media. I got to stop trying to do it all myself. Now we have a Google team that does all our marketing for us. It alleviates all types of time to focus on working with people directly day in and day out. I'm not like plugging and playing all day. I'm focusing on what's in front of me. So you have to give up some things and allow certain people to do things, but you got to surround yourself with the right people to do that. And that's going to take mistakes. That's going to take successes. And I think in the private lending space, I don't think people have enough, and I'll call it tombstones of experience, and they're coming into the field and they're kind of just throwing things up on the wall and hoping that they stick. It doesn't work that way. You need to understand and learn from your mistakes. I know AI and I know ChatGPT is great, but if you don't have the personal experience to understand what's going on in front of you from a past event or a past scenario, you're not going to be able to facilitate quick. And this industry is so quick. Putting a loan together, getting it submitted takes minutes now. Can you imagine in 3 to 5 years, it's going to take seconds, right? If you don't need to order the appraiser and chase some person down and go get the appraisal, and it could be all done internally, how quick can a loan close if it's down to within a 3% margin of error, right? What if, I mean, title companies are almost to the point of virtual. Do you really even need an office? You could just work from this coffee house at this point as a title agent or a title company. So, like, I mean, the air of, oh, I need to go to an office to close is so less concerning now in our space. I can't remember the last time I went to a closing. Remember all the loan officers used to take all these pictures at closings? That is 10 years ago, man. You're stuck in like 2002, right? Things are moving very quickly toward streamlining everything through AI, prop tech. I don't see it slowing down, especially in the non-QM space. To me, I still think the banks are playing catch up, and will they be completely caught up with non-QM in the next 5 years? Potentially. I'm not going to say no, but they know they're behind. Alex, good morning and welcome. Brief overview who you are, what you do, and thoughts to the future of private lending. Alex, going once. There you go. Alex? Alex, we can't hear you. Alex, I would suggest coming in and out. We cannot hear you. Okay. We'll go to Kazi. Kazi, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion. Oh, Alex, you there?
Yeah, I'm here.
All right. So brief overview who you are, what you do, and the future of private lending.
Hey everyone, my name is Alex. I'm a real estate investor and construction manager in Milwaukee, Wisconsin. I think that the future of private lending is on the rise, as everyone else has indicated. I can speak firsthand. I work on a government operated project, and there's a lot of inefficiencies and slowdowns when you have all the regulations in federally mandated items. So anytime you can switch over to private, be more efficient, you're either going to save money and or save time. So I agree with everyone else. Contributing information is more accessible, even in the Gen Z crowd that are more or less struggling to find the financial means to get into a property. I think that private money could be a even more lucrative option for them to get in versus conventional.
Alex, thank you. Thank you very much for coming in, Alex. I met Alex last year in Milwaukee. So thanks for no. What is private lending and non-QM at this point? And I'm going to give you kind of a bullet point breakdown what a true non-QM lender does in the asset-based lending space currently. And there's a couple little moving parts to it. And if anybody says they do something outside of this, it's most likely a brokering environment. Okay, so a true direct private lender works on very specific things: 1 through 4, single family through 4 family, 5 unit to 12 unit in the multifamily space, all residential, on the DSCR, refinance or purchase. They also look at 2 through 8 mixed use, meaning a blend of residential and commercial, at least at 50% each. On the fixed to rent, fixed to flip, 1 through 4, residential, 5 through 12, multifamily, anything above 12 units. Traditionally, a non-QM lender will go up to 5 million, meaning 12 unit, probably up to a 25 unit on the fixed to rent. Some non-QM lenders can go above as long as they know they have a exit loan, whether it's Fannie or Freddie, on the way out. Okay, that's true bridge financing. In the new construction space, non-QM, 1 through 4, build out, build up, or 5 through 12. Anything about 12 units, it's out there. It's case by case. Now, are there some wish lists for some non-QM lenders? Yeah, my wish is to have a program strictly for rural properties, single family through 4 family. And another wish list would be modular new construction built. Now, will that all come around as costs and concerns of migration rentals and migration opportunities present themselves? I think so. Do I think it's going to happen this year? No. But that's pretty much what a direct private lender in a non-QM space does. They don't work on self-storage. They don't work on RV parks. They don't work on mobile home parks. They don't work on fit outs of warehouses, office retail. That's what a true non-QM lender does. And if it is do anything outside of that, they're brokering. And when somebody calls me, hey, I got this restaurant I want to buy in a building, just call my friend that's an SBA lender. Knock yourself out. I don't do that. And a true non-QM lender will say that and just say, listen, it's not my lane. And you need to find your lane in this space. If you identify the lane of bullet points, the opportunity of volume of inquiry back is infinite. Kazi, good morning and welcome. Brief overview, who you are, what you do, and the thoughts to the future of private lending.
Yes. Hey, thanks, Joe. Appreciate you holding these rooms every Sunday and just throughout the years, on Clubhouse. So definitely appreciate that stuff. And then too, keep me posted about the Jersey City event too. I'm gonna send you a back channel on my email.
It's always the third Tuesday of every month. Okay. At 902 Brewery on Pacific Avenue. We have a lender panel in May. 3 of my other colleagues, Matt from Alpha Funding, Anthony Cisco from BD Capital, and Nick Bianchini from Maverick. I'm doing a panel with them third Tuesday in Jersey City from 6:30 to 8:30. It's going to be a great event.
Yeah. I'm definitely gonna check that out, man. For sure, man. A lot of great opportunity out there. And thanks, Joe. And I'm Casey. I'm based out of Milwaukee, Wisconsin. We focus mainly on affordable housing. Well, honestly, 100%. Affordable housing, permanent supportive housing. So sometimes our projects are 100% permanent supportive housing, or like a great 20% of permanent supportive housing in the overall project. And those units are usually catered to folks who are better or intellectual as new construction and adaptive reuses. And Joe, as you talk about private lending and affordable housing, I think that's something kind of interesting that can be here over the next years or so, or even sooner than that. Typically in affordable housing, we use a lot of definitely grants, as Alex mentioned. Grants whether it's from the city, county, state level, or federal level, and then year terms. That's the thing about affordable housing. It can be tricky sometimes with attainment loans. Any loan that come in affordable housing has to be a 15-year term at the minimum. Then typically we see anywhere from a 35 to a 45-year, amortization. But where I can see an opportunity in private lending and affordable housing is on the construction financing side, bridge loans or, acquisition, financing. But again, we had to stay in that, deal for at least 15 years. And then I think, particularly even gap financing, right? Assuming, that lender is comfortable, staying in the deal, for 15 years. And I think it's different ways too that we can incentivize private lenders, if you will, in order to, collaborate with them, whether that's incentivizing them on portion of the development fee, or maybe portion of the equity buyout at the end of the, refinance period in year 15. There probably could be some other things in there as well, that can be, incentivized, if you will, because I think the period. But again, I think like the construction would be the quickest, for the lender to get out, right? We typically see anywhere from, depending on the size of the project, right, 12 to 24 months to build, these mixed use developments. And so, yeah, we even say through the pre-development financing. I think that could be another opportunity as well. And affordable than a year, offered different things I see, at least as of now, that for private affordable housing, but city opportunities in affordable housing.
Yeah, I just recently went to a presentation in Philadelphia provided by UDA, which is Urban Development Association. We are sponsoring one of their events in May on the 22nd, a happy hour and a workshop. And Alan Nachmanson, who's an attorney, does a lot of work with the UDA. It's a group focused on the Black and Brown community in Philadelphia, and there's a lot of other relevant groups that are out there throughout the country in the urban settings. They're offering these turnkey programs through the city, through the land banks, and they're somewhat convoluted. But you could get into some of these type of developments for affordable housing or selling off for home ownership to affordable housing environments. And I mean, there's some moving parts. I like the program. I do see the risk if you don't sell these properties. They claim they got plenty of people that want to buy these properties, but I always don't like I don't like walking across a tightrope without a net underneath me. That was only some of the concerns I had. And actually the UDA director called me because I was poking at the questions and was concerned about the exit strategy. And he talked about it with me, and he's like, "Yeah, this is not a proof safe, program. You got to know what you're doing. That's why they're limiting the amount of properties at a time that somebody can do this." And I think there's still and he agreed there's a lack of financial literacy in the space that they're working on to kind of fill that gap because the affordable housing, whether it's from a home ownership or from a rental perspective, the investor needs to get their acumen up to the right level to be able to understand how to take down one of these deals. And he did agree where, my bridge lending is a little more straightforward, from a credit perspective, from a rehab perspective, it's a little cleaner, it closes quicker. These programs take longer, they're a little more cumbersome. You kind of get the good or bad news 2-3 months later, where I'm giving you good or bad news 1 week later. So it's like, because we're all based on the appraisal. So that's the difference. I feel like I do appreciate the government programs out there, but they're bulkier, they're more Spanish Armada. I feel like the future of private lending is more British Bulldog, quicker, sleeker, moving in and out. I think it's much more for the investor that's starting out, where they don't feel overwhelmed if they surround themselves with a true expert. I think they're going to walk away with a lot more education and understanding how to put a file together themselves. Understanding the construction budget and draw schedule is very important. Most people don't even know how to take a scope of work from a contractor and transpose that into a construction budget and a draw schedule. So, like, there's that insufficiency of education that needs to be provided to a lot of investors. And we provide that in our white label underwriting courses as well. Eddie, good morning and welcome. Brief overview who you are, what you do, and thoughts to the discussion this morning, the future of private lending. Eddie, going once.
I think Eddie might have left out, Joe. And I would add to it. I think there might be just quickly. It might be. I think another opportunity I mentioned is maybe in a naturally occurring affordable housing. You know, with existing assets that level if you would potentially be about a 20-year contract with the naturally occurring affordable housing. You know, I said that. I think that's another opportunity. You know, on the things that already exist and already went through its 15-year compliance period.
Well, thank you, and thank you for that, Kazi. And there's a colleague down below, a current client of mine. I won't call him out right now, but he's down below, and I got to give this gentleman a lot of credit. He has a great administration behind him. He understands his numbers. He understands his values. Actually, we just recently closed on a project this past week where the value came in way much higher than he came in as an estimate. That's a true real estate professional. Okay, when you're expecting, you're not expecting everything to just go right. You understand your debt service, you understand your affordable housing rentals, you understand your project, you understand what you have into the deal, you understand the not to go too over leveraged, I think is important as well. And I love when I see that because what happens is it makes every project going forward with the processing department so much easier because it's a level of respect being recognized. Amy, did you want to give some final thoughts to our discussion this morning on the future of private lending?
Oh, I just wanted to ask a question, but oh yeah, we're running at the top of the hour.
That's okay.
One question, I'll make it quick, is so in 5+ units, obviously that's a commercial loan. And I guess a non-QM, it doesn't, I mean, you have a little more leeway, but are you seeing any sort of, to round out the capital stack, people using CPACE? Because that, if you're building doing any sort of green improvements, you can use kind of CPACE financing that way. And that was kind of my question. And then I can add more thoughts, but that was my question.
In the 5 through 12 space of multifamily, small balance multifamily, when somebody's coming to me for DSCR, I'm not seeing a lot of that. I'm seeing full renovations and value adds, but I'm not seeing any of these other pieces of the pie that have to be taken into account on the refinance or purchase. Because the loan sizes are anywhere between 250 and probably 5 million, or actually, I won't even say 5 million. I'll say between 250 and 2 million, and that type of space is kind of under the radar for a lot of people and a lot of what you're asking about. And I haven't encountered. I've probably closed 2 to 3 multifamily buildings, 5+ units a month, and I have not run into that once in the past at least 3 to 5 years at all.
Do you close any in California? Because those are a little higher price tag, and so I would just.
The inquiries I'm getting and closing in California are more flipping, surprisingly enough, in the surrounding San Francisco area on single family. Anytime I've been presenting a 5 through 20, say, unit multifamily in California, the client usually disappears midway.
Yeah, it's a bulk of the multifamily stock. I don't know if you know that in California, but 80% or 90% of the stock is like less than 20 units.
California kind of runs on its own little lane there somewhere. You know that, right?
Yeah.
And we'll leave it there, nicely. But I mean, for the rest of the country, we're not seeing a big problem with DSCR on the multifamily. It's definitely all in the appraisal. And we do now the difference between a 1 through 4, which is a standard appraisal, commercial appraisal, and the MAI appraiser, we're restricted to who we can use, which is, I mean, usually the more respected MAI appraisers that are out there. But I think that's going to streamline too as well with prop tech and AI over the next 5 years as well. I think that'll take a little more time than the 1 through 4 appraisal environment. I think that's going to have a massive consolidation as the industry ages out. So we're rounding the hour here on our 100th episode of the Creative Burst Strategies podcast here on Clubhouse. And I want to thank our supporters. Listen, we've had many, moderators come and go in good or whatever way works out for them. Sometimes silence usually answers all questions, in my motto. I want to thank the current moderators, our audience, our followers. We get somewhere between 4,000 downloads a week now between what we do and marketing. We have an excellent Google team to promote and support events regionally, nationally, locally. I'll be also at the Landlord Convention in Indianapolis with Jeffrey Taylor. I'm going to be in South Carolina with Anthony Kazazis and his expo in Charleston, South Carolina. Very excited about both of those coming up this year. I am doing a class trip with a lot of the people that I am teaching white label with. We're going to a class trip to Las Vegas, which is kind of ironic and funny. As a grown adult, we're going to the American Association of Private Lenders in November. So if you do come through one of my classes, I am arranging a trip out to Vegas for that event in late November, November 10th and 11th. Because I believe people should grow and learn with opportunities. Amy, do you have something to say on that?
Yeah, as long as you're cooking, I'm going, Joe. As long as you're cooking.
I can throw it down. You've seen my meals posted. I'm in semi-retirement. On cooking. I've been my wife has banished me away from the kitchen because I leave a lot of mess, but I do throw it down. I have been told I have a legendary crab gravy, so I do that a couple times a year as well. And Uradella has been a fan of my Sunday dinners over the past 10 years, so he could testify to good food and good eats. And you got to listen, you have to have boundaries too. You got to have time for family and food and fun and all kinds of stuff. And yes, Deborah, I will be reaching out to you early on before we get out to Vegas. But yeah, if anybody's interested in having that time with like a class trip, I'll call it, upcoming in the fall, I look forward to that as well. And I want to thank our sponsors. I want to thank Mr. Perkins of Perkatech, who is really the backbone to this podcast that we have every Sunday. I want to thank him for administrating my social media platform and marketing and events. When I go to a different event, I walk in, someone like, "You're everywhere." I said, "I'm right here." But what Uradella has allowed and helped me be available and out there and very accessible to real estate professionals and services throughout the country. I want to thank Lendmark Capital, where I'm a senior loan analyst, providing asset-based lending nationwide in the private lending space, DSCR, fixed to rent, fixed to flip, multifamily, mixed use, new construction. I want to thank MB Capital, who supports me as a referral partner for them in providing unsecured business lines of credit for real estate professionals and business-to-business individuals throughout the country. I want to thank Realty 411, Miss Linda Pelagas, who helps support me in a national presence with her national publication and her events throughout the country. I'd like to thank Elite Dealmakers, where I'm now hosting events on their behalf in New Jersey and Pennsylvania. We're looking to expand that into Delaware and Connecticut as well, and working with the Sub-2 community and hosting their events or co-hosting their events in those local meetups. I'd like to thank TCS Property Management Services, where my licenses are held for real estate in New Jersey and PA, and they have other markets that they're in providing property management services. And then I offer CE courses nationally in asset-based lending for real estate investors and agents throughout the country. And I'll be in multiple states this month coming up, Connecticut, Rhode Island, Philadelphia, South Jersey, New York. Just had a wonderful event in New York for the Sub-2 community at 110 Fifth Avenue, the Compass corporate office epicenter of New York City, which was a lot of fun. And, I think about getting to 100 episode of something and staying committed and consistent and staying professional and staying undistracted is so important in this business. You got to stay undistracted. You got to stay focused. You got to be clear. I feel like the most important thing in private lending, you need to talk to people. You can't be talking through Facebook Messenger or text all the time. You got to have a conversation. That's what's going to separate you from the rest of the herd. It is so important being a real estate professional and talking with somebody. If somebody's not willing to spend 2 to 5 minutes on the phone with you, why would you want to work with them? If they want to keep it to text or some form of other crazy communication, there's a personal touch being a professional in your space. And if somebody's not willing to give you the time, you got to think about where the cost benefit relationship is for you as a real estate professional or as a real estate investor or a real estate service. You got to think about this because there's only so much time in the day to work with people that are going to want to work with you, right? And I feel like that's the future of private lending. I think the hiding behind certain things and not willing to talk to people and giving people news. That's the beauty of future of private lending. It's business. It's not personal, and it should never get personal. You're going to give news the same way, whether it's good or bad or indifferent. You need to provide the information as quickly as possible. Pulling the Band-Aid off every single minute of the day while you're working is so important in this space. We're here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. My quote this morning: see your goal, understand the obstacles, create a positive mental picture, clear your mind of self-doubt, embrace the challenge, stay on track, and show the world you can do it. Everybody have a blessed Sunday. Please follow me and a lot of our moderators here on Instagram, LinkedIn, Facebook. Allow us to be part of your real estate community through the Creative Birth Strategies house and podcast here every Sunday morning, 9 a.m. Everybody have a blessed Sunday. I'll be ending the room in the next 30 seconds. And thank you.
Be blessed, everyone.